Dan Morris is a global strategist at JPMorgan Asset Management. Dan, thank you so much for coming. I think the first question should be, do you think the vote will result in this getting approved by tomorrow?
I would think so. I mean, certainly there's a lot of pressure coming on all the members of Congress right now, understanding that if in any way they let the deadline pass without an increase in the debt ceiling, that the consequences will be just so dire that it would certainly do them no good, or the economy as well. So certainly we expect that to happen.
And so do you think there's a contingency plan in case the vote doesn't go through? I mean, they won't have time possibly to vote another plan. We heard rumors that the Fed may be looking to do something.
I think any of them have to be ready in case there were a scenario when by Tuesday the debt limit hadn't been raised, that there would be way for the Treasury to continue paying bills if it took another day or so. It's just certainly something that no one really wants to have to go through. But I don't expect that if for some reason it didn't happen by the end of the day tomorrow, that suddenly payments would stop. There's cash available if needed.
Dan, in terms, of course, of what that means for the credit rating agencies, even if they do get this passed through, it doesn't mean that the U.S. is safe from a credit downgrade.
Definitely not. I mean, the targets that S&P have talked about was $4 trillion, which are numbers we've already heard bandied about over the previous negotiations over the last couple of weeks, and we haven't really got there yet.
At all?
No. But I think what the credit rating agency should take into account, or hopefully will take into account, is that at least it's a step. You've had a fundamental change in the debate, in the dialogue in the U.S. I mean, just these discussions about potentially cutting Medicare, Medicaid, Social Security would have just been impossible to imagine a year ago. So it's a real change in mentality. The process is messy. It's going to take time, and it should take time because this is a real fundamental issue that it shouldn't be decided, frankly, in a couple days. So if the $4 trillion doesn't come by tomorrow, I think that's fine. If it's over the next year, I think that's fine as well, and the credit agency should take that into account.
But then, if let's say that they actually do decide to downgrade it, and the U.S. wakes up and instead of being AAA, it's now AA, what would the consequences material be on investors and the rest of the world?
I think actually the actual effect on yields potentially be quite small. I mean, if you look at examples in the past, and there's not a lot, where you've had a developed country downgraded from AAA to AA, the change in yields, in some cases they went up slightly, in some cases they actually went down. And if you look at what happened when S&P first announced the negative watch, nothing happened to yields. I mean, what's really driving U.S. Treasury yields right now, and more or less always will, is expectations for economic growth. I mean, the GDP numbers for the U.S. last week were really terrible. That's what's bringing yields down below 3%, not really this discussion about the long-term fiscal outlook.
And of course, Dan, the dollar will remain, for now at least, the reserve currency. But I guess the problem is, if they lose their AAA credit rating, does it not mean that certain fund managers have to get rid of treasuries just because they won't be AAA credit rated anymore?
Potentially, but I think it's a relatively small number compared to the size of the U.S. Treasury market. I mean, that's $10 trillion. If you lose a couple billion here or there, I mean, certainly it's going to be significant for those funds, but not for the market as a whole, and I don't think necessarily all that significant for the dollar either.
So overall, what would you be buying today? What are you, telling your investors to do ahead of the vote, and then once the vote goes through, but still, of course, this potential downgrade looming?
Well, in general, we still believe that equities are very undervalued globally, and certainly developed markets and in the U.S. So what's been holding them down is very much this negative sentiment initially coming out of Europe, now coming out of the U.S. So I think the U.S. negative sentiment should lift. Europe a bit, though we know it's
German bonds or anything else? Equities or German bonds?
German bonds, no. I think especially bonds in general just seem extremely expensive. I mean, if they're under 3%, growth is lower, so they're not necessarily going to rebound as much as we might have thought last week before the GDP numbers came out. But as you have a reversal of this flight to quality, they're going to react. Yields are going to go up. Equities should consequently rally, and the difference in the return, I think, is going to definitely want to make you buy equities and not bonds at this point.
And what about currencies? Because we're hearing, but it hasn't been confirmed at all, that the Bank of Japan is still weighing whether they need to start intervening on dollar-yen.
Sure. Well, with the yen now having actually broken through 80, it's a concern. Toyota's numbers seem to be affected what it already is a strong yen. So I think that's certainly possible that they will try to bring it back down. How much it'll really go above 80, is always the debate, because if that's where the market wants to go, there's only so much that a central bank can do.
All right, Dan, thank you so much. We have to leave it there. But basically, you think it's under control, the situation in the U.S.?
It will be okay.
Okay, great. An optimist.